What is your view on the very low interest rates in the United States along with the U.S. bond markets?
Well, we think the low rates in the United States, we know we believe we know what's going on. We understand why the Fed is trying to massage them low, but we think it's unfair to investors. So to back up a little bit, we have a credit-based economy, John, and it's driven by a lot of borrowing. Our parents and our grandparents' generations, what they did is they saved money before they bought something. But in America, it's credit-based. So when interest rates are low, the economy flows until there's too much debt and people stop spending, which is what happened recently. And rates were massaged lower and lower by the Fed. And then the Federal Reserve Bank has started to do things also in helping bail out big Wall Street banks, which is a whole other subject. The Federal Reserve Bank has effectively started to print trillions, has printed trillions to buy government debt. So the central bank of the United States of America has printed money, on one hand, trillions, buys pieces of paper called government treasury bonds that are pieces of paper, promises to pay, buys the bonds, holds the treasuries, or maybe not. The government now has trillions, they spend the money, i.e. go further in debt. Ultimately, they've got to pay the principal back on these bonds. So what happens is this: when you have a, and it's not, there's a famous money manager out there that calls this a rigged bond market. There's a famous person of note that calls this a rigged bond market. And what that means is this, and we believe it is a rigged bond market, because if our bonds were only sold not to the Federal Reserve Bank, and it was only the Chinese or the Saudis or individual investors, they would demand higher interest rates because of the worsening fiscal situation of the United States of America. But by the Fed, in our opinion, being a rigged buyer, they just print the money, buy the government's bonds from the government, at artificially low rates, in our opinion. Mm-hmm. See, the market, we believe, would demand higher rates. So what happens is this: Grandma Jones or a retiree or any investor that wants to have some of their money or all of it invested conservatively cannot get a high rate on government treasuries, or cannot get a high rate on CDs in this environment, because the rates are being kept, in our opinion, artificially low by the government. And it benefits the government because it's massively in debt. It does not want to pay high rates to service the debt. The bond market, Cliff Notes, we're staying away from the bond market. It's our opinion that the bond market has at a 30-year bull with nothing but declining interest rates, the inverse relationship. You love to hold, for example, a 6% bond when new ones are being held issued at 3%. Right. You can maybe you can get a premium when you sell that 6%er. On the flip side, when rates are at a very, very low, which they are right now, 30-year low, when you have that right now, the last thing, in our opinion, we want to see our clients do is hold a long-term bond paying 3-ish%, when all of a sudden we see, in our opinion, the cost of a lot of things going up already. But if new ones are all of a sudden issued at 6 or 8 or 12, which we think ultimately is going to happen here, it's our belief, we don't want them getting stuck having to make that painful decision, which is this: I either keep taking it on the chin, make 3% on my money, and watch my standard of living go down, or I've got to sell these at a deep loss and try to buy some new ones paying 8 or 10 or 12 if rates go there. So that's our opinion on the bond market.
Everyone needs to know that. Thank you for sharing that with us today.